You know, a new space race is definitely on. But this time, it's not just about planting flags and leaving footprints. We're talking about building a real sustainable economy on the moon. So as an investor, how do you even begin to navigate this new frontier? Today, we're digging into intuitive machines to answer a pretty crucial question. Is this a ground floor opportunity, or is it a mission that's just a little too risky to take on? Okay, let's get into it. Every gold rush needs its picks and shovels, right? The essential tools and services that make everything else possible. Well, in the race back to the moon, a whole new breed of company is popping up to build that critical infrastructure. And one of the companies really trying to be that go-to supplier is Intuitive Machines. So to figure out if this is actually a solid investment, here's our game plan. We'll break down this new lunar economy, get a look inside Intuitive Machines' business, weigh the good and the bad, the bull and bear cases, we'll run a valuation, and then we'll leave you with the final verdict. Now, the picks and shovels strategy is a classic for a reason. Instead of trying to bet on a single gold miner who might strike it rich or, go completely bust, you invest in the company selling the tools to all the miners. In this new lunar economy, that means investing in companies building the landers, the communication networks, the data services, basically the very foundation of any mission, whether it's NASA looking for water ice or some commercial company planning to mine for resources. So what kind of tools is Intuitive Machines bringing to the table? Let's pop the hood and take a look at their business model. The company really operates across 4 core areas. The first, and let's be honest, the most visible one, is their lunar lander business. This is mostly driven by NASA's CLPS program, where NASA is basically hiring private companies to be their delivery service to the moon. Now, while that's their main source of cash right now, they're definitely playing the long game by building out a whole space data network, offering high-level engineering services, and, thanks to a recent acquisition, even making their own satellites. And that move, well, that really shows you their ambition. Buying Lanteris Space Systems was a total game changer. It took them from being just a LUNR delivery service to a vertically integrated company that can build the hardware, connect it with their network, and operate the whole shebang. This end-to-end capability gives them way more control over their timelines and costs, which is a huge advantage in an industry where delays are common and incredibly expensive. So, with that foundation set, let's look at the bull case. There's a lot of excitement swirling around this company, and for some really solid reasons. First off, they literally made history with the Odysseus lander. We're talking about the first successful U.S. moon landing in over 50 years, and the first ever by a private company. That wasn't a fluke. They've delivered, which gives them this massive first-mover advantage and a level of credibility that their competitors just don't have yet. Their contract backlog is growing like crazy. It's already close to $1 billion. And, crucially, they're locking in key partnerships with U.S. defense agencies and European space programs, all while playing a role in NASA's huge Artemis missions. But hold on, it's not all clear skies and rocket launches. For every potential success story, there's a risk of failure. And that's true for the investment case, too. So now, let's look at the bear case, because there are some really significant risks to think about here. What's really important to get here is how these risks all kind of feed into each other. Their heavy reliance on government contracts, that's a major vulnerability. A budget cut could be devastating. The technical risk is just huge. I mean, even their successful IM-1 mission ended with the lander tipping over on its side, which limited what it could actually do. And all of this is happening while they're just burning through cash to grow and facing off against absolute giants like SpaceX and Blue Origin. This mix of risks is exactly what keeps cautious investors up at night. And that brings us to a really crucial point about the management's philosophy. They are operating as capability builders. They're prioritizing growth and grabbing market share over immediate profits. Now, for an investor who's looking for stable, predictable cash flow, this kind of growth-at-all-costs approach introduces a much, much higher level of uncertainty. And all those risks make this next part absolutely critical. This brings us to the ultimate question for any investment. What is it actually worth? We have to separate the market hype from the fundamental value, the story from the spreadsheet. So recently, the market has been pricing the stocks somewhere in the $23 to $32 range. This is what people are willing to pay for it right now, based on that exciting story we just talked about. But what does the math say? If we strip away all the hype and just focus purely on the company's ability to generate cash over its lifetime, what is it fundamentally worth? That's what we call its intrinsic value. Oh, right. Based on a discounted cash flow model, the estimated intrinsic value comes out to around $12.43. Whoa, that is a significant gap. At its recent trading price, the stock is way above its calculated fundamental value, which means there's very little, if any, margin of safety. Think of that as your buffer against bad luck or a miscalculation. In this case, that buffer is pretty much gone. You're paying a premium with almost no room for error. So if the fundamentals suggest the stock is overvalued, why is the price so high? Well, the answer lies in the story that the market believes. To understand that narrative, we've got to look at the technical chart. So this here is an Elliott wave analysis. It's a way of looking at charts to spot patterns in market psychology. The whole theory is that markets move in these predictable, repeating patterns, 5 waves up, 3 waves down. And what this chart suggests is that Intuitive Machines is right in the middle of a powerful 5-wave upward trend, which points to a period of really strong investor optimism. This table kind of lays out the roadmap. You can see the time periods and the price ranges for the first 4 waves. The key takeaway here, though, is that according to this analysis, we are now entering wave 5, which is typically the final, most powerful surge in a rally. So here's the crucial point. The technicals are telling a completely different story than the fundamentals. The Elliott wave analysis suggests a potential price target of over $60. But, and this is a big but, there's a major warning sign here. The Relative Strength Index, or RSI, is at 78. Just think of the RSI as a momentum gauge. Anything over 70 is considered overbought, meaning the stock has gone up too fast, and could be due for a sharp pullback. It's like a flashing yellow light on the dashboard of this rally. So where does that leave us? It's time to bring everything together and frame the final decision. On one side, you've got the bull case, a first mover in a potentially massive new economy, with real achievements under its belt, a solid backlog, and a very bullish market trend behind it. On the other side, you have the bear case, a company that isn't profitable, is incredibly risky, and, based on the numbers, looks fundamentally overvalued. And that brings us to our final question for you to really think about. Is Intuitive Machines a visionary bet on the future of the lunar economy, where the current price is totally justified by its huge future potential? Or is it a high-risk venture that's already priced for a perfect landing with almost no room left for error? Really, the answer depends on whether you trust the spreadsheet or the street.